Today we're going over the 5 home ownership traps that my clients come to me every day with because they didn't listen to me the first time. Thank you for watching. I'm David Zai Mortgage Guy, and I've been helping people just like you navigate the home buying and home ownership process for over 19 years. Hey, leave a like on this video and let's get started. What are these traps? Number 1 is going to be market volatility. The second thing we're going to talk about today is structural issues, location pitfalls, financing traps, and then finally hidden costs. So stay tuned. We'll go over each one in detail, and by the end, you'll be able to spot these traps before you spring them so that you never have to fall for them. Let's talk about market volatility and how it can affect your home value. Market crashes, sudden drops in property values, and economic downturn. During the 2008 housing crisis, many homeowners found themselves underwater on their mortgages, owing more than their homes were worth. Buy within your means, consider the local economy, and don't rely on property appreciation. Here's a strategy to protect yourself. Always have an emergency fund to cover 3 to 6 months of your mortgage payments. The way that I do it is that I get this started by paying myself a portion of my mortgage on top of my monthly payment. I take these funds and I put them into a high yield savings account. That fund will continue to generate interest, and if you're fortunate enough to not use much of it, it can be a great starting point for your next down payment. Through prudent financial planning, let's talk about my previous customer, Emma. She demonstrated the value of emergency savings. After purchasing her home, she faced a challenging period when the market declined and she experienced a 4-month job loss. However, thanks to her emergency funds, she maintained her mortgage payments and kept her home secure. Although she needed to take out a 401k loan during this period, she actually quickly rebuilt her finances after securing her new employment and has since paid back the retirement account through accelerated repayments. Next, we're going to jump into structural issues. Structural issues can turn your investment into a money pit. Foundation problems, mold, electrical issues, and plumbing disasters. I had a customer, Tom. He purchased a charming old home only to find out that it needed $30,000 in foundational repairs. He had to take out a second loan to cover the cost. Hire a reputable home inspector, look for signs of trouble, and get multiple repair estimates. Did you know some issues may not be visible during standard inspections? Thermal imaging can actually help uncover hidden problems. Home inspectors have been using thermal imaging inspection to discover hidden water damage in walls. With these types of issues underlying, you can use these opportunities to negotiate out of the contract, reduce the sales price, negotiate repairs that are caught by a home inspector, or walk away. Pro tip here. Make sure you physically attend your home inspection, and when you're calling that home inspector, you're going to ask 2 questions. Number 1, do they do the thermal imaging inspection? And secondly, are they nationally accredited? It's very important. Let's go into location. Location, location, location. It's more than just a mantra. High crime rates, poor school districts, and noisy neighbors are all things you can't tell by just viewing a listing online or taking one trip with your realtor to visit the home. When my wife and I were looking to buy a house, our top priority was our school districts, the composition of the home that we're going to buy, and just looking at future resale value. One of the first homes we found was a beautiful brick home tucked away in a cozy neighborhood with a lake in the backyard, and I'm a huge avid fisherman, so that was right up my alley. Almost like a movie house, but it was dramatically underpriced. Before factoring its excellent location, we got a little suspicious. So we decided to do a drive-by, and we drove by the house on a Friday night, and we were absolutely devastated. Apparently, the nearby university happened to be associated with this neighborhood, and the home that we had set our sights on was right in the middle of fraternity houses. Needless to say, none of this information was disclosed up front, and we would have never known the mess that we were about to sign up for. Be sure to visit the area at different times and talk to the neighbors. When evaluating a property, assess beyond the physical structures to understand the broader neighborhood dynamics. Property values are significantly influenced by its surrounding factors and potential future changes. Key considerations include zoning plans that may lead to eminent domain claims, environmental risk like flood zones, neighborhood compositions where mixing house values could affect appraisals, and the quality of property management through HOAs or condo associations. These external factors can substantially impact your investment's long-term value and stability. By researching your future city plans, you can ensure your investment grows as new amenities are built. Lastly, let's discuss financing traps that can lead to financial strain. Here's a clear breakdown of these important mortgage considerations. Number one, we want to look at ARMs, adjustable rate mortgages. You have to understand exactly when and how often your rate can adjust. Know the interest rate caps, both per adjustment and over the life of the loan. You need to consider whether you can afford the payments at a maximum possible rate, and be aware that initial teaser rates typically increase significantly after the first period. And always, always, always calculate the worst case scenario for monthly payments before committing. Let's say you do an adjustable rate. The way that it works is you'll go in at a teaser rate. Let's just say that the going conventional rate is at 7%. When you take an adjustable rate, they may tease you with a 6.25% rate. With that, we're taking a calculated risk as the investor. All right, we're giving you a 6.25% rate, which is 3/4 points below the fixed rate mortgage right now. However, after a certain period of time, whether it be 3 years, 5 years, 7 years, 10 years, 15 years, there's going to be that first adjustment. The shorter the term, the better your rate and cost is up front. And the longer the term, like 15 years, the more it's going to cost. However, at the end of that term, and let's just use 3 years as an example, your rate can go up or down by, let's say, on average, 2% max. Okay, so it can go to 8.25%, or it can drop down to as low as 4.25%. You have a 4-point spread in this different scenario. So you have to be prepared for the worst case scenario of that 8.25%. And you know what? You should be jumping for joy if you get that 2% drop. So it's definitely a calculated risk when you're doing an adjustable rate mortgage. Now let's jump into hidden fees. The loan estimate has to be disclosed to you within 3 business days. So make sure you're carefully reviewing that loan estimate and the closing disclosure that goes out 3 days before your closing. On there, you're going to have a lot of different fees. You're going to have the origination fee, which is the cost of doing the loan. You may have an application fee, which is truly a junk fee. There's a processing fee that pays the processor that's doing the loan. There's an underwriting fee, which is basically the investor's cost to underwrite that loan. There may be rate lock fees. A lot of investors and lenders don't charge a rate lock fee to secure that lock. If you do pay that, that is non-refundable, and that's typically charged on longer locks. Let's say locks that are longer than 120 days. That is normal in those longer locks, but shorter locks under 120 days, you should not have to pay a rate lock fee. There's different types of points, such as discount points to buy down the rate, but it's really important to watch for junk fees with vague descriptions. Question any fees that you don't understand, and make sure you compare the fees across multiple lenders. In the video that I'm going to put down below, we talk about the different types of lenders. Wholesale lenders, there's retail lenders, there's banks, okay? And it's really important for you to know the differences. The wholesale guys are going to be able to go to different investors, and there's different types of guidelines for every investor. There may be overlays that are specific to this investor that other investors may not have. So we basically shop for you, like that insurance broker that calls 50 different companies to get you the best quote. Then you have the retail guys. They work for someone. They have multi-level management, and with that, they have someone to kind of go to if they run into issues. So with that, you're paying that extra cost. And that's why, based on 2021 HMDA data, and we'll put the link down below, on average, a consumer will spend between $8,000 to $11,000 more when going retail over wholesale. And then finally, you have the bank. Hey, the good old boy network, you may be able to get a better deal if you go to the bank, but 9 times out of 10, they're also retail, okay? So they have that middle level management. Everyone has to get their cut. Definitely do your due diligence, find out what works best for you. Next, we'll jump into prepayment penalties. Prepayment penalties are really important. You have to check to see if your loan has a prepayment penalty clause. You have to understand how long the prepayment penalty lasts. What does that mean? You sign up for a loan and there's a 1-year prepayment penalty. That means that if you pay off the loan, you refinance the loan, or you sell that house before the end of that 1 year, you're going to have to pay a penalty. All prepayment penalties are going to vary, and they can be as little as 2% and they can be as high as 10% in some cases. Know what action triggers the penalty, and those are the full payoffs, partial payoffs, or any refinancing. Partial payoff is the key. If you have a partial payoff to pay it down and there's a penalty and you don't want to do that, let's just say you're buying a house and you're also selling one, but you don't want to go contingent, you don't want to be penalized that if you sell your house that has $200,000 equity and you put it into the new house, you're gonna get penalized on it. You don't like that. That's not good. Calculate the exact cost of the penalty. Know the calculation by heart. So if you do have to exercise the prepayment penalty, you'll know how much that penalty will be. Consider negotiating to remove the prepayment penalty up front with your lender, because every lender will allow you to remove that prepayment penalty. It's just what cost comes along with it. Primary residences typically do not allow prepayment penalties. And finally, be especially careful with these penalties on adjustable rate mortgages, as they can trap you into a loan where rates increase. And what's really important is to understand your loan terms. Choose that fixed rate mortgage if you don't understand the parameters of non-fixed loans, and read the fine print. It's really important to read all the pages of the documentation. Don't just read the loan application and the loan estimate and say, hey, I trust you, loan officer. That's happened too many times. I make it a point to go over everything with my consumers so that they can understand that loan estimate, right? That loan estimate is gonna be like your grocery store receipt where, hey, I bought bread, I bought some celery, I bought some tomatoes, I bought some chips, I bought some ice cream, I bought some milk. There's the breakdown of every section of the loan estimate. Then there's the total. And then you have the taxes, and then you have the recording fees, and you have then homeowner's insurance and all these other things, okay? It's really important that you understand it and you're working with your loan officer and having them interpret everything to you that you don't understand. One thing that's happening a lot now is refinancing. Refinancing is a quick way to save money in a pinch, but watch out for prepayment penalties that can negate the savings. These kinds of hidden fees and undisclosed costs are always in the fine print, but that's because no one expects you to read it. If you arm yourself with the information, in many cases, these fees can be negotiated away, drastically reduced, or properly planned for. Let's talk about some hidden costs now. Property taxes and insurance. While property taxes are well known, many buyers are surprised that without a 20% down payment, they must prepay 2 months of property taxes and 2 types of insurance at closing. The first type of insurance is PMI, mortgage insurance, or private mortgage insurance, or mortgage insurance premium, depending on the type of loan that you get. This truly does protect the lender and not you, but it is required with a down payment under 20% and added costs that don't directly benefit you. The second type of insurance is going to be homeowner's insurance. This actually protects the property and the belongings in the house, as well as liability, and it is required for all mortgages, and it does benefit you directly if there are any claims. All of these costs must be disclosed in your loan estimate up front. If you don't see them on your loan estimate, question your loan officer and make sure that it's added in there. Let's talk about home maintenance. This is something that I've done a lot recently. Unexpected repairs aren't inevitable. It's really important that if you're gonna buy your first home, or this is a house that you're just now buying, I always recommend to get a home warranty at closing, because if you get it after, you will need to wait 30 days before you can file a claim. Investing in basic tools and repair guides are absolutely necessary. I've bought more tools since I started owning homes than I ever use. And it's actually saved me a lot of money, because DIY can save you thousands on simple fixes. And always use YouTube videos. I've used that to fix a lot of like toilets and other issues that I've had. And finally, know your limits. Don't attempt any repairs beyond your expertise. Next thing to consider is commuting cost. During my early career as a loan officer, I bought what seemed like an affordable suburban home. However, with the first loan officer job that I had, there was a 2-hour daily commute in my 1997 Toyota Camry that actually added about $500 in monthly fuel costs, plus the significant time lost while driving. Instead of relocating, I ultimately changed employers after 9 months. This experience taught me that a more expensive home close to work can actually be more cost effective when factoring the transportation expenses. Leave a like. It goes a long way to helping me share my knowledge with other first-time home buyers like you. While you're down there, subscribe. If you want to get in contact with me, head over to my website, davidzimortgageguy.com, and Zy is spelled X-I-E, and check out the links in my description. Until next time, I'm David Zy Mortgage Guy. Thank you for watching.